Your parents probably did everything right with money. Saved consistently, avoided debt, put money into FDs, gold, LIC policies, bought land when they could. And it worked. They actually built wealth doing exactly that. So, why won't that same strategy work for you? Here's what nobody tells you. The exact same action, saving money every month, parking money in bank, buying gold that made your parents wealthy are now quietly making you poor. Not because saving is bad, but because the entire game has changed. The rules have flipped and almost everyone is still playing by the old playbook. Your fixed deposit isn't growing your money anymore. It's just slowing down how fast it shrinks. By the end of this video, you will see exactly why copying your parents' strategy is now the riskiest thing you can do with your money and what to do instead. Let me be very clear about something first. This isn't about blaming our parents or calling their methods outdated. What they did was brilliant for their time. They played the game that was in front of them and they played it well. The problem isn't that our parents were wrong. The problem is that we are copying their outcomes without understanding their environment. We are following the same playbook, but we are playing on a completely different field. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. Stay with me till the end because the mistake most people make with money today, it's not what you think. So let's start from the beginning. Let's actually first understand why saving works so beautifully for the previous generation. In the 1980s and 1990s, India was high interest, high inflation economy. Yes, inflation was high, but here's the thing most people miss. Interest rates were even higher. Fixed deposits regularly offered 8 to 12% returns, and even your regular savings account paid meaningful returns. So, when someone saved money in a bank, that money wasn't just sitting there protected, it was actually growing at a real rate. Let me give you a simple example. If inflation was running at 6 to 7% and your FD was giving you 9 to 10%, you were comfortably beating inflation without touching the stock market, without taking any so-called risk. Saving made sense because it had growth built into it. I remember my grandmom used to live off just FD interest without the worry of losing money. Now, compare that to today. FD rates hover around 5 to 7%, and after tax, many people are effectively earning 4 to 5%. Meanwhile, real inflation, which includes education, healthcare, rent, and everyday lifestyle costs, often grows faster than that. So, when you park money in a bank account today, it's not growing, it's quietly losing value. The same action that once built wealth now barely preserves it. Here's another thing that we conveniently forget: access. In our parents' time, capital markets weren't easily accessible. There were no investing apps, no SIPs, no low cost index funds, information was limited, education was complicated, and stock markets were seen as a place for traders and speculators, not for regular people building long term wealth. So people didn't avoid markets because they were foolish, they avoided markets because markets were distant, opaque, and honestly intimidating. Saving through banks and buying physical assets like gold or land, that was the most practical and transparent option available to them. If you're getting value from this, just like and subscribe. It just takes 2 seconds, helps a lot, and we can get back to the good stuff. Now here's where the story gets even more interesting. Honestly, this next part is why I made this video. Let's look at the regional differences in how wealth was built across India. In South Indian states, Tamil Nadu, Karnataka, Kerala, Andhra Pradesh, wealth creation historically revolved around 3 things: fixed deposits, gold, and real estate. Equity investing penetration was extremely low. Even today, many families in the south equate stock market with speculation rather than ownership. Gold in particular became default long-term asset, and it wasn't just jewelry. Gold was savings, it was security, it was social capital all wrapped into one. Real estate played a huge role too. Land was affordable, urbanization was just beginning, population pressure was lower. So, buying land early created massive wealth over time. Now contrast to this with Mumbai. Mumbai evolved as India's financial capital. Stock exchanges, brokers, financial institutions, professionals all concentrated in one place. That exposure created familiarity, and familiarity created participation. So in Mumbai and parts of North India, equity culture grew faster while South stayed conservative for much longer. And again, this wasn't ignorance, it was context. But here's the truth, every financial strategy has an expiry date, and over the last 2 decades, many of these old certainties have quietly expired. The same strategy that once built wealth is steadily failing today. Let's start with interest rates. They have normalized, come down significantly, but inflation hasn't disappeared. For most households, the inflation they actually feel in daily life often runs higher than the official numbers, plus or minus 2%. This has created a widening gap between what your money earns and what your life costs. Earlier, bank interest comfortably filled this gap. Today, it barely manages to keep up. Now let's talk about gold. Gold has seen a subtle but important change in its role. Historically, gold served two purposes. It protected purchasing power and over long periods delivered reasonable growth. That's why it became a preferred long term asset across generations. Today, gold functions primarily as a hedge. It protects value during uncertainty, but its long term real returns still uncertain. Now, I know actually what you're thinking. What about the last 2 years? Gold has been on a significant bull run. And you're right, since the Russia Ukraine war began, gold prices have surged. Add to that the growing distrust in the US dollar, countries watching America freeze Russian assets and impose sanctions overnight. Suddenly, central banks around the world started thinking, what if we are next? So, what did they do? They started buying gold aggressively. China, India, and other countries have been stacking gold reserves like never before. That's a big reason gold has been performing so well recently. But here's the thing, that rally is driven by geopolitical fear, not by gold suddenly becoming a wealth building machine. When the world feels unstable, gold shines. But when things stabilize, they actually eventually do, gold tends to flatten out. It doesn't compound, it doesn't generate income, it just sits there holding value. So, yes, gold has had a great run, but relying on global chaos to continue so your portfolio grows, that's not a strategy, that's a gamble. Gold remains a hedge, a safety net, a crisis insurance policy, but it's not something that you can count on to build serious long term wealth. And having more than 10 to 15% exposure, anything above that is you seriously overexposing yourself. And here's where it gets even more uncomfortable, real estate. The one asset everyone trusted tells a similar story, only more sharply. Entry price for house, flats, and land have risen dramatically. Rental yields are low, often they struggle to even beat inflation. Liquidity in real estate is poor. Transaction costs are soaring high, and most importantly, today's buyers are entering the market after decades of appreciation have already taken place. Think about it. Our parents bought land when it was still affordable, before cities expanded, before demand truly picked up. We, on the other hand, are trying to enter the market after prices have already absorbed decades of growth, speculation, and limited supply. The asset hasn't changed, but the point at which we are buying it has. Let me make it concrete with a simple example. Suppose in the 1990s, someone saved 10,000 rupees a month and put it in a fixed deposit earning 9% interest. Over 20 years, that money would grow into a meaningful corpus even without touching equities. Now take that same 10,000 rupees a month, park it in a savings account or an FD earning around 5%. Over 20 years, sure, the number on the paper will go up, but not meaningfully. Once you factor in inflation, rising education fees, healthcare expenses, and everyday lifestyle cost, the actual increase in purchasing power is very, very small. Your bank balance looks healthier, but the cost of living keeps racing higher. That gap between what your money shows and what it can actually buy is the illusion many modern savers are stuck in. And this illusion leads to the single biggest mistake people make with money today: copying results without understanding the environment that created them. People look at their parents' financial journey and say, they saved consistently, so if I do the same, I'll end up in the same place. That logic feels reasonable, but only on the surface, because it ignores the condition that made that strategy work in the first place. Like we discussed earlier, interest rates were significantly higher, meaning even simple savings earned meaningful returns. Asset prices were far lower, so land, gold, and housing could be bought early and cheaply. Life expectancy was shorter, reducing the number of years savings had to support, and healthcare and education were far more affordable, taking a smaller share of household income. These conditions created an environment where saving alone could build wealth over time. But today, that environment no longer exists. Interest rates have fallen, assets have become expensive, the cost of living has risen sharply. What changes is the outcome, not the strategy. You follow the same action but get completely different results. And this brings us to the central question: why has not investing quietly become one of the biggest financial risks today? For a long time, stock markets were seen as the risky option. Volatile, unpredictable, suitable only for experts. Safety was associated with savings accounts, bank deposits, golds, and physical assets. That perception made sense in an earlier environment. But in today's reality, the definition of risk has completely flipped. Inflation has become a certainty, not a possibility. Prices rise every year, whether you participate in markets or not. So, when your money grows slower than inflation, it loses purchasing power quietly, without any alert, without any warning signs. The number in your bank account increases, but what those numbers can buy steadily declines. Not doing anything with your money is now an active decision, a decision to accept erosion. Earlier, investing was a choice. You could save diligently, avoid markets, and still end up financially comfortable. Today, that option barely exists. With better healthcare, life expectancy has increased, healthcare costs have risen, education has become expensive. Delayed peak earnings have made growth essential, not optional. Investing has shifted from being an aggressive move to being a defensive one. It's become essential. This is also why we are seeing a slow but structural change in behavior, particularly in the regions like South India. Equity participation is rising not because people suddenly became risk loving, but because access to markets have improved. Understanding of finances have now improved. SIP culture has normalized market volatility by spreading investments over time. Mutual funds have made diversification simple. Information is widely available, transparent, and easy to consume. Most importantly, young earners are realizing the hard truth. Salary growth alone is not enough anymore. Traditional assets no longer carry the same wealth creating power they once did. The shift we are witnessing isn't emotional or fashionable, it's mathematical. People aren't changing because they want to, they're changing because the numbers are forcing them to. And this is where the past, the present, and the future finally meet. We are not saying our parents were wrong. They played the game that was available to them, they played it very well. But now, the rules of the game have changed. Saving alone once built wealth. Today, saving without investing mostly just delays the problem. Respect the wisdom of the past, but don't blindly inherit its strategy. Because in today's world, saving keeps you safe, but investing is that what allows you to move forward. Let me know your thoughts in the comments. Why do you think saving alone isn't enough anymore? And also, what's been your experience? Your parents built wealth by saving, you build wealth by understanding when the rules change, and more importantly, changing with them. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thanks for watching, and I'll see you in the next one.